Guys, welcome back to our second part of our risk topic. And the second part's all about our VAR, our value at risk, and our stress testing as well. Now, this is the first kind of calculation-based section. And very, very likely there's one or two calcs coming up here, but also equally likely to interpret what we mean by these risk metrics, value at risk and stress testing as well, guys, too. Just as a link to our previous section, guys, remember the three types of losses. Guys, the expected loss, the unexpected loss, and the catastrophic. Just going to put catastrophic loss here. We mentioned this briefly before, but it's at the heart of this little section here. Remember we said, guys, expected losses are going to be high frequency, low impact. So guys, this particular reading, this particular section is not about those high frequency losses, high frequency, low impact, the things that happen every day. Is not what it's about. One of the ways to think about this as an analogy would be the weather. Guys, so this is coming to you from London, and we get quite a rainy season here in the winter time. And one part of the country, different parts of the country, yes, have different degrees of rain, for example. But if you're thinking about the average rain, the average or mean here, the expected loss or the expected rainfall would just be the average. So guys, if you were thinking perhaps of 100 winters, yeah, you're thinking about a 100-year period, 100 winters, then the average level of rainfall wouldn't cause any problems to anyone at all. If you're thinking about the unexpected levels of losses or rainfall, then you'd have quite a severe low frequency but high impact event. Guys, low frequency, high impact event. So I guess, for example, you might define that perhaps as maybe, for example, 99% confidence or 95%, because these are confidence levels. And what we mean here is that if we're talking about 95%, then there are only 5 winters in 100 where the rainfall is more severe. Or perhaps even 99%, only one winter out of 100. The idea, guys, of a 100-year storm, perhaps. Now, here in the winter time last year, we have a town called Carlisle, and the level of rainfall was way, way higher than they'd had in decades. More down the catastrophic route here. So catastrophic would be very low frequency and very high impact. There's very high impact there. Just make it a little bit clearer here. Yes, very high, very low frequency, very high impact. So to summarize, guys, the key area we're going to look at in this chapter, we're going to start off by looking at the second category. So our value at risk is a measure of quite a severe level of loss. Quite a severe, it's not a measure of the worst possible loss. The catastrophic is even worse than that, but it is a measure of quite a severe level of loss. If we're going to look at the tail risk, or very, very extreme, beyond our estimates, guys, then we're into the catastrophic area with stress testing and scenario analysis as well too. Remember we said before that risk capital is heavily linked to the unexpected losses. So guys, what is value at risk? Let's talk about this in a bit more detail. Often written in this way, of VAR. Well guys, this was invented in mid-1990s, 1995 or so, by JP Morgan, and it's certainly widely been used, widely been picked up by the regulators, widely been used ever since then. Our chapter does mention that value at risk should never be used on its own. It should always be kind of used in conjunction with, guys, the stress testing. Why? Because the stress testing will look at losses beyond the value at risk. Remember, guys, VAR isn't a maximum. It's purely looking at those unexpected losses. Losses could be higher than that. So the first key word, guys, to mention here is the word estimate. If I was to say to you, okay, next year, what will the temperature be like exactly 1 year from today? Well, you might say, okay, well, I'll think about of the mean or average. I can look up the charts. What is the mean or average temperature for that particular month of the year? Or you could look at more of a severe, the unexpected, more of a severe type of temperature. Or perhaps thinking about a catastrophic, a very, very severe level that's very different from the average. So when we are talking about an estimate, will our value at risk be accurate? Guys, probably not. So it's quite dangerous putting a lot of store on a single number. That's where the stress testing comes in as well, guys, to explore, well, what if we're wrong in this way? Quite a famous one here is that in London, the JP Morgan London Whale example, their value at risk estimate was 70 million and the actual loss was well into the billions. So it just shows you we can't rely on any number. We could be wrong. We could be wrong here. Now, VARs are described by their probability, level of probability. For example, guys, here, they're quoting, for example, a 1% VAR. Do you want to do a little bit of work on this? Make sure everyone's okay, because this is a common area for questions. Let's talk about our VAR here. So guys, you can think of, these are the two common metrics we use here, 95 and 99. And these guys, these here are confidence levels. If we're working in confidence levels, then we're thinking of the maximum loss but if we're thinking in terms of significance levels, so guys, here you have 5%. Here you have a 1%. Then we're talking about the minimum loss. And the way to, I guess, to think about this, guys, here would be this. If we think about a distribution, remember that VAR is focusing, guys, here on the left-hand side. VAR is focused here on the losses. So if we're thinking about perhaps firstly a 95% confidence level, this is how we would interpret. We'd say, guys, well, 95 winters out of 100 or 95 days out of 100, the maximum loss we estimate, let's say, guys, here is $1 million. Guys, and that leaves an error. So what the significance level is here, guys, this is the error. Remember, in any kind of statistics, we can't be 100% accurate. There's also an error level. So what this is saying, guys, is, well, 95% of the time, we're confident our maximum loss will be 1 million, but 5% of the time, our minimum loss will be 1 million, and it's very likely it's going to be a lot more. VAR does not describe, because VAR does not describe how bad the losses might be, guys, in the tail there. Remember, to explore the tail, we're going to need stress testing and scenario analysis. So, guys, if we're talking about VAR as a maximum loss, you're referring to the confidence level. If you're talking about VAR, the significance level, you're talking about the minimum loss. And in the exam and in the questions, you can often find that they'll give you, for example, here, on our slide in a moment. We might talk about perhaps the 1% VAR. Obviously, they're talking about the significance level there, but they could easily have called that a 99% VAR as well. I just want to briefly link in something that's coming in very shortly, guys, here. How do you explore beyond our VAR? Guys, we call this kind of tail VAR in our syllabus. Guys, tail VAR is the mean or average loss beyond our VAR estimate. In real life out there, in a lot of the other texts and regulators call that expected shortfall, sometimes call it conditional VAR. In our book, they're calling that tail VAR. So guys, tail VAR is the mean or average loss beyond the VAR. So guys, looking at the definition then here, we've got our estimate of the minimum. If it's the minimum, it's at the significance level. If it's the maximum, you're using the confidence level at a specified level of probability, like we said, over a time period. So guys, you could have a 1-day VAR, you could have a 10-day VAR, you have a 1 month or a 1 week, you could have a 6 months VAR, a 1 year VAR. You can estimate over any time period. I've got an example for you here. So we have the 1 day, so 1 day VAR here of a portfolio there is 2.6 million. Now, the way it's often interpreted out there is often to start with this one here. They'll often say, well, that means there's a 99% chance or 99% of the time the portfolio will lose no more than 2.6 million. Guys, if you're working in trading days, say 250 trading days, 250 times 0.99, that's 247.5 trading days. Our maximum loss we estimate to be 2.6 million, but you've got an error. Remember, our significance level is the error, so 2.5 days a year, the minimum loss will be 2.6, and we don't know how much more. It could be an awful lot more. Guys, everyone okay with that idea? So like we said, using 1%, 5%, using using 99, using sort of 99% confidence level or 95, that's most common with VAR. By the way, guys, we're talking a lot about VAR for market risk. The slides do say you can use VAR for credit risk, you can use VAR for operational risk. But it's much more tricky trying to model things like operational risk when you don't have as much data. So the context for us is much more in this chapter about market risk. That's the main context here. A lot of the regulators picked up on VAR very quickly, and you'll often see perhaps a 10-day. They might talk about working out VAR for a 10-day period. That's no accident, because that fits with a lot of the regulations for quite a long time. In real life, that 10-day period had assumed that you can liquidate most positions in 10 days, because we know in real life, when you have a crisis period, liquidity risk kicks in, maybe you can't. So it's only kind of in recent times that they've challenged this 10-day period. Guys, if you work in risk today, you'll know that they're looking a lot more at liquidity risk as being a key thing to watch out for, of course. Okay, so we'll come to a part in the VAR section where you might need to recommend an approach. This is quite common in the morning. There's quite a lot of areas in CFA, often tested in the morning, where you have to recommend one of three. And you'll be given some kind of a scenario. And this scenario has heavy clues leading you down one of these routes. So to be able to recommend the right approach, the slides that follow, guys, explain a bit about them. One of the main things about the first one here, they call it parametric. Now, guys, parametric means that it relies on a normal distribution. And straight away, that is the weakness. Because we know that markets, if we put up a normal distribution here, we know that markets, even in normal times, do they actually follow a normal distribution? That's a big kind of question mark. Much more common to have that kind of leptokurtic idea going on. Guys, and you see this before quite a lot in the CFA program, where you have the fat tails here, and the higher peak, that higher kurtosis. If you use this first method and the markets are leptokurtic, also guys, for example, skewness. In this chapter, it's worth keeping in mind what we know about skewness too. So for example, if you have, say, I don't know, a negative skew, very common, many of our alternative investments, many of our assets are negatively skewed as well. It means you're going to underestimate the losses. Guys, you're going to underestimate the chance of outliers. So the analytical method, this is the one that has the main calc coming up in 1 second. It does have the famous calc, and the calc is quite easy to do because it does rely upon this normal distribution here. In reality, perhaps these two methods are a bit more highly used because they don't rely upon this assumption of a normal distribution in there too. One problem perhaps with the second one that the past questions might link in on, what if there's been a regime change? Guys, I go back a little way, but I can remember when I first started in a bank back in 1990, believe it or not, interest rates in the UK were really high at 15.4. Guys, there's obviously been quite a different change in regime for interest rates since then. If your data has changed, then will that method represent the future? So watch out for that in the past papers. They tell you about that your view is that the past won't represent the future, then you shouldn't use that particular method because it will be nothing like correct. If you also guys have portfolios that are heavily with non-linear exposures, guys, for example, like options, the Monte Carlo simulation is the one that's most preferable. So watch out for that. Any clues about non-linear exposures? For example, maybe you've got a long straddle. So guys, if you're doing the risk section, the derivatives is coming pretty shortly in your run of videos. And I know from level 1, level 2, you'll know about straddles. Remember, guys, where you forecast volatility in either direction, up or down. What would be your maximum loss? Guys, have a think. What would be your maximum loss with a straddle? Well, you've bought a long call, you've bought a put. Your maximum loss when there's no movement at all. So Monte Carlo simulation could model those kind of unusual scenarios. And that would be preferable when you particularly have options in the portfolio. So guys, just a quick recap then. We need to know a bit about each of these three approaches. We're going to cover the key calculation very shortly on the next slide. In the exam, you're often asked to, there's a calculation with the first two actually that I wanted to show you. Very, very likely. But you could also be asked to interpret what VAR is and all the parameters we've been talking about as well too. Now VAR is normally a dollar amount. For example, the maximum loss at a 99% confidence level over a 1-day period is 10 million. It's normally a dollar amount. It's not normally, say for example, guys, we have here, I don't know, 10 million. Interestingly, you don't put a minus in front of it. So people know it's a loss. There's no need to put a minus there at all. You could think of it as a percentage. It's not normally the way it's expressed. Now, guys, I want to talk a little bit about the first approach then. This is the analytical approach. Remember, the parametric VAR has the problem of the normal distribution. So, guys, let's focus in on how this works. Make sure you're okay with the calculation coming up here. Guys, so this first one here is going to be, they call it the variance covariance approach. It's also known as parametric or analytical VAR. Guys, it's also known there as analytical VAR. You can see that, okay, analytical VAR2. And also parametric VAR2. Yeah, the variance covariance approach, the analytical VAR approach. Let's have a look at how it works. So guys, now I'm going to show you the full formula here because I think you need to know it. And then we're going to look at our example on screen. So guys, VAR, let's have a one day VAR, and let's have that, guys, at say a 95% confidence level. So the first thing to say is you could call this a 5% VAR. If you're thinking about the significance level, the error rate, that means that 5% of the time you'll be wrong. Or you could think about a 95% confidence level. Remember, if thinking about the confidence level, that's going to be the maximum loss. Think about the significance level, then that would be the error or the minimum loss. But guys, the one day VAR is going to be equal to, now we're going to put, guys, here the expected return, and we're going to use the mu here. That's the one day. Guys, the one day expected return minus our Z value. Guys, more of this in a moment. Our Z value multiplied by our standard deviation for one day. And that gives us a percentage, and that percentage multiplied by our portfolio value. Now guys, I'm going to make up some numbers here. Let's talk about the Z values first. So guys, when you think about a normal distribution, just for a moment again here, we're going to focus in on the lower tail, market risk, the lower tail. We're focusing in on the losses. That's perhaps a criticism of VAR. It only focuses on one side, but it's useful to explore the losses, of course, here. Now, if we have a normal distribution, guys, let's have a look at our two key confidence levels. Let's have perhaps 95% confidence level, and let's have here, guys, 99%. Now notice that if our 95% confidence level, just make up a number, guys, here, say that was 1 million, what's going to happen when we go further out into the tail? So as the further out we go into the tail, the losses are going to increase. So maybe, guys, here, I don't know, maybe it'd be 10 million, for example, here. But the point is, the higher the confidence level, the more extreme losses you are incorporating. So guys, in some parts of the regulatory structure, they even go to 99.9 as well. So let me make up some numbers here. When we look at the 95% confidence level here, we need, guys, a Z value of 1.65 standard deviations. Now, you know from your level 1 and level 2, that's a one-tailed Z value. Hence, we're using 1.65. And to get to 99 here, from the normal distribution tables, guys, that would be 2.33 standard deviations. So in this calculation, we do need these Z values. So in our example here, let's just do our full example here. So let's have, guys, the expected return of the portfolio of 10%. Let's have the risk of the portfolio, guys, of 15% here. Let's have a 95% confidence level, and let's work out here a one day VAR. A one day VAR. Okay, guys, so how we handle it here. Remember, guys, so our VAR for 1 day, there's our mean return minus, guys, the Z value multiplied by our standard deviation there for 1 day as well, multiplied by our portfolio value. Let's say that the portfolio value here is 1 million. Let's have 1 million here. There's our expected return, guys, of 10%. Now we're going to use a 95% confidence level. You should be given this, but 1.65 is going to be our Z value, that one tail value. The risk per day, let's have a 15% standard deviation. Guys, let's work out the value at risk there for 1 day. 1.65 multiplied by 0.15 minus the 0.1 times the 1 million. Guys, comes here to 147,500. Yeah, 147,500. Now what that means here is that the maximum loss at a 95% confidence level, meaning 95 days out of 100, is 147,500. But there's an error, guys, because 5% of the time it will be wrong, and the minimum loss will be 147,500, and we don't know exactly how much higher. It could be a lot higher than that. So guys, notice what's happening here is this expected return of 10%. 10%, guys, of 1 million is 100,000. So our loss is really an extra 100,000. This return is reducing our loss by 100,000. So in the exam, looking back at past questions, most of the time they will ask you this formula. Okay, so most of the time they will be testing with an expected return given to you. One thing to watch out for here, just a little thing to watch out for, is what if they asked you not for 1 day, but they asked you perhaps for 10 days? Guys, if they want a different time period, you're going to have to adjust the return here times 10. You've got 1 day return, you're going to have to adjust it multiplying by 10. But guys, how do you adjust the standard deviation? Remember your knowledge, guys, from CFA program? Here you're going to multiply by the square root of time, the square root of time rule. So just remember that, guys, if you are adjusting for a different time period and you do have an expected return, you are going to have to use that square root of time rule for standard deviation, but you don't need it for the return itself. Now, if there's no return given, just going to briefly show you this. If there's no return given, the VAR formula just simplifies slightly. And what we would have, guys, here is the VAR, again for 1 day. And it just becomes, there's no return in here, so the Z value multiplied by the standard deviation, again for 1 day, multiplied by the portfolio value. So in the exam, I think this is less likely. It's much more likely you do have a return in there. But what the book says is over very short time periods, perhaps that mean is 0. And guys, that would be your formula here. And just to show you the numbers, if we were to rework this, guys, here, what we'd have our 1.65. Again, we'd have our 15%. We'd have our 1 million portfolio, 1.65 times 0.15 times 1 million. Notice that the number, our VAR number, has gone up by 100,000. Why? Because we no longer have the benefit of that 10% expected return. So guys, out there in the risk world, it's quite common to use VAR and not assume any positive return at all. It's quite common to be more cautious. So I suppose using this particular formula is a bit more cautious, and it does result in a 100,000 higher potential loss. Guys, quick recap before we leave this. We're going to show you an example coming up now of applying this formula, and we're going to actually use the second one. But the quick recap, quick tip I would give you, the VAR formula, very, very testable. You can see how you could perhaps interpret the VAR formula. Very likely, perhaps for 4 or 5 marks, you have to use the formula. A little tip here as well before we leave it. It's more in the actual teaching phase we show you this. Always show your workings. Guys, write out the formula, label it briefly as well, show the values. You're going to get marks for that as well as the actual number. So coming back to our slide here, we're looking at one-tailed values, and so remember that for our 99% confidence level or our 95, most questions would give you those one-tailed Z values. They're going to give you those mostly. Like I said, guys, the expected return or mean is in the VAR formula. It's in that formula. But over very small time periods, it might be assumed to be 0. If it is provided, always add it in. If it's not provided, use that shortened formula. So when would you use this one? Well, it is quite simple, but it does have that big disadvantage of that normal distribution. That is a real problem. In real life, you're massively underestimating the risks. Even in normal times, guys, in a crisis period, what about the fat tails? What about the skewness? You're going to massively underestimate the risk. Guys, they mentioned very briefly here, if we do assume a normal distribution, then, for very small changes in the underlying, then perhaps we can rely upon delta. We know that for larger changes, that isn't going to hold. Guys, the idea that it's not a linear change, for example, gamma coming in. So for small changes, perhaps we might use it, but we'd much prefer anything involving options to use which method? The Monte Carlo simulation method's better. Okay, guys, so if you're on the video here, first thing I want you to do is to write out the formula. Okay, so we'll write out the VAR formula. Now, in this case here, we're looking for a one-day VAR. We have been given a portfolio value. We have been given, guys, a volatility, but we haven't been given the mean. We're going to use our adjusted formula. So, guys, what we've got here, we've got our Z value multiplied by our daily risk of volatility for 1 day, guys, multiplied by our portfolio value. Guys, as I mentioned already, in the real exam, much more likely you get a mean, you're going to have the mean in there as well. But for this one, let's put some the numbers in as well. Guys, so we're on a 5% VAR. What will the Z value be? Well, guys, it's 95% confidence level. That should be 1.65. There's the risk, 0.006. Portfolio value here, $1,000. Guys, we can work out the VAR here. 1.65, 0.006 times the $1,000. Guys, what we get here then, our estimate of our VAR, $9.90. What does that mean? Guys, you can look at it two ways. If you're looking at it in terms of the confidence level, that is the maximum loss. The significance level, that is the minimum loss. Remember, guys, confidence level, it's saying 99 days out of 100, our maximum loss at a 99% confidence level is $9.90. But there's an error. Remember that error? here 5% of the time, 5 days out of 100. If you've got business days, 250 business days, that means, guys, 12 and a half business days per year, we expect the loss to be higher. Because we don't know how much higher. The minimum loss will be 990. We have to use stress testing, scenario analysis to explore that further. Guys, again, so that's our example here. For the exam, just remember the main formula is slightly different. Just going to remind you guys, make sure you're okay with it. Much more likely for the real exam paper to work out of you would have a mean. That would be our mean return here for 1 day. Isn't in this particular question. Then comes in the Z value. Here's our standard deviation for 1 day. And all that then is a percentage multiplied by our portfolio value. So guys, that's much more likely, I think, based upon the past papers. But what they do like to play around with here, like I mentioned, is the timing. Maybe they want a 10-day, so you have to perhaps adjust for a 10-day VAR like we talked about before. Guys, but you've been through far worse, so that VAR calc here, you've been through far worse, it isn't too bad. Looking at the answer here, we weren't given that return. We're going to assume it's going to be 0. Now notice, guys, that the way they've laid this out, they've put a minus in front of it. In reality, in the exam also, you don't tend to put a minus in front of the number. People know it's a loss. Yeah, people know it's a loss. They've just kind of tried to make sure we understand that, which is fine, because we know it's going to be a loss here. Yeah, 5% of the time, then the loss, that is the maximum loss. That's our confidence level, as we know, but it does leave that error. That significance level is the error. So you could call that a 5% VAR or a 95% VAR, whichever way around you're looking at things. Okay, guys, so that's our first method. That's the parametric method. Just to focus as where we're headed here. That's our first method here. Going to head on now to the second method, the historical method. So guys, let's say that we are in 2006 here, and we're looking back at past data. We're looking back at the past, and I guess at that period was kind of pretty less volatile. You have got a really volatile period, 1998, goes to the famous Russian default back then, but pretty much the data period was a lot calmer, really. We know what happened further on, guys, 2007, 08, of course. So I guess that's part of the problem with this method here. Will the past, be anything like the future? Now, it has a lot of benefits, this method here. One of the key benefits, guys, we're going to use real returns, actual returns. And what you do here is you line these returns up, guys, from the highest all the way down to the very worst, the lowest. Let's just say, guys, we go for 100 months. N here is 100. We're looking at 100 months of data. What I'm going to show you here, I'm going to show you the worst 5 returns. The very worst one was minus 85%. That we had a minus 77%, minus 74%, minus 62%, and minus perhaps 60%. Now, guys, I've given you a snapshot there of the return distribution. Now, notice, first thing to say is that, if you have 100 different months you're examining, the VAR isn't interested in the worst one. This one here, minus 85, is the very worst. Well, that's not required for our VAR. Our var is about which value represents the 5%. So guys, all you do here is n times the significance level. In this case, it's 5%. So guys, 5% of 100 means that we're looking for the 5th worst. We're interested in the 5th worst. Guys, so 1, 2, 3, 4, we're interested in that minus 60%. What we're saying, guys, here is that by looking at the distribution as to how bad the losses were, we can find the return that represents any particular significance level. Guys, so what to look out for here is the data set, the number. How many returns are there? Guys, if you had 500 returns, 5% of 500, the 25th lowest return, etc. And what we do with this is say, okay, well, our portfolio, guys, our portfolio, I don't know, say perhaps 1 million here. Let's use this particular return, guys, to estimate our loss. So, okay, well, looking back at the past, that minus 60%, guys, we potentially, our maximum loss, maybe say, for example, 600,000. So guys, you're using the past data to predict the future. Now, in the exam, remember, you might be asked to recommend an approach. If there's been a regime change, guys, you not use it. You might use the analytical method, or you might use the Monte Carlo simulation. So they're going to give you clues to recommend the correct method, guys, here. Okay then, guys, so in real life, one little thing to add here, sort of thing that the FRM mentions quite a lot here, just a very brief thing to add in, is that in real life, you could perhaps take these past returns and make some changes. Guys, you could change the weighting system. You could also perhaps change the volatility, a bit like turning up the heat or turning down the heat, turning up the risk, turning down the risk. So in real life, a lot of analysts may perhaps take the data as a starting point and then perhaps turn the heat up, change the weighting system, and perhaps make the past data a bit more relevant for the future. But in our exam, for our CFA Level 3, they're going to leave the data alone, and if it's not relevant for the future, don't use this method. So guys, one of the key advantages here, let's say that you are looking back now over the, 2007 period, kind of to date. Especially if you were looking at the particularly volatile periods, guys, you could capture a real crisis period. In real life, they came up with a metric, guys, called stressed VAR. It's not something they have. Our syllabus, this really is quite an old one, but in real life, stressed VAR uses the most stressed data. So it's kind of just as we've been talking about, but using the most stressed data you can find in that way. Guys, they call that stressed VAR. So one of the benefits here, it doesn't really matter what distribution it is. It could be heavily negatively skewed, heavily leptokurtic. We don't need a normal distribution here at all. That's why they call that non-parametric. Guys, non-parametric, remember our first method was a parametric method that did rely upon a normal distribution. But will the past be anything like the future, guys? Who knows? So guys, we've had our analytical method. We've had our historical simulation. Our final one is our Monte Carlo simulation. And what we do, guys, here, computer modeling, generating often thousands of possible futures. So guys, they can use simulation for all kinds of forecasts, all kinds of future outcomes, whether it might be interest rates, different scenarios, economic scenarios, for example. But what you do is perhaps you have, 10,000 perhaps simulations, line up all the returns from highest all the way down to the lowest. So guys, it's very similar to the historical simulation, except that these have been generated by your computer modeling. So here you've generated these from your modeling, whereas in the historical simulation, you've got past data from real life. And then you look to find, well, if we're looking at a 5% VAR, which return represents that number? I meant to mention this, guys, before. You know, when you are counting back in real life, say you have, guys, here, for example, say you have n is 100, for example, and we want to find the fifth. Say you want to find the fifth worst return. In real life, some analysts might take the sixth or an average of the fifth and sixth or some sort of average. But guys, remember that any assumption you make is probably wrong anyway. How accurate is your VAR going to be? Because it probably isn't going to be worth anything anyway. Remember, it's only a number. It's a bit like trying to guess the temperature, you know, a year from today. So that's where all these assumptions, whether you take the fifth or the sixth, is it a big deal? Does it really matter too much? Only for our exam, of course. For the exam, you will take, guys, the significance level, of course. But in real life, what we're saying here, there's so many assumptions, it's probably going to be wrong anyway. That's why, guys, our stress testing and our scenario analysis is very important. So, guys, again, very, very useful for options and for nonlinear relationships. And interestingly, if you had, say, 100,000 different paths, 100,000 simulations, you would get kind of a normal distribution coming in eventually, because you'd have some really high, some really low, some in the middle. They start to converge in a way. So watch out for those questions that say they don't rely at all on normal distribution, because in the Monte Carlo simulation, it does in a way. The more you have starts to converge to a normal distribution anyway. But you can model non-linear relationships, like we said before. But guys, garbage in, garbage out. Beware those inputs too. So summing it all up, guys, from the early days of the mid-90s, our JP Morgan, heavily used by the regulators. And it's only really this year, guys, 2016, they're proposing to make a change to finally leave behind VAR. VAR will still be in the background, but it's going to be kind of surpassed in a way. We're going to see in a moment what's coming in. But VAR still with us, still very much a part of the toolkit, but it shouldn't be used on its own. And one of the main problems, the distribution assumptions a problem, but one of the main things we're going to look at, guys, here, if that's our VAR estimate, is what about these losses that are beyond VAR? Guys, how do we handle those ones? We're going to have a look, guys, at the tail VAR coming in, and the stress testing. So that's where the regulators are going with this. And that's where kind of risk is going with that. We're realizing that losses can be a lot more catastrophic sometimes than our VAR has predicted. This is the problem, guys, here. It can give you a false sense of security. When you see our maximum loss, people might take that quite literally. Guys, it's only the maximum loss at a confidence level. There's an error there too. One of the key problems, I guess, in the industry that is picked up here quite strong in the second point, guys, here. If you gave a lot of analysts the same data, they often come up with very different estimates, even with the same data. Perhaps the method, perhaps the assumption, perhaps the timing of when the data period, guys, the assumptions that you make. So the regulators have a lot more switched on now, guys, to model risk. Now this video I'm making today in September, there's been a lot of changes this year in real life, and the regulators have restricted a lot more operational risk VAR. They're kind of saying, well, it hasn't worked. A lot of the freedom to model VAR hasn't been too accurate at all with operational risk, and they're standardizing it. They're very worried about the variations in the outputs. So guys, VAR itself is a model, brings with it a lot of model risk, and maybe it can't capture some of these more complex situations and scenarios. Once you have a VAR model, the regulators require, guys, that you backtest to validate the model. In real life, you have to backtest, guys, over a 1 year period, and it's to check, well, how many exceptions are there? How many times was your model inaccurate? If you have a small number of exceptions, they might let that go, but you have quite a large number of exceptions. It says, well, your model isn't accurate enough. Go back and sort it out. Okay, guys, now you might be asked a bit about beyond VAR or some variations on VAR. The main one of the main ones, well worth a mention, guys, here. Let's have our VAR in here. Perhaps that might be, a 95% perhaps confidence level. Mentioned this, guys, a couple of times already. One of the main ones to mention is this one here, tail value at risk. Now, out there in the industry, this word here, the expected average, is often how it's known here. So I'm just going to make sure you're okay. Expected shortfall. What it is, guys, look at the losses that are beyond the VAR, and they extend way into the tail, don't they? But the expected or tail VAR, as we know it in our syllabus, tail VAR here is the mean or average loss beyond our VAR. So there are some losses that are just a bit over, some that are a lot over. It's the mean or average loss that's beyond our VAR. And as we stand here, guys, in 2016, that's the recommendation that's been made now by the regulators in the industry to move away from just VAR, but to start to set regulatory capital using this measure here. So, guys, a lot out there in the industry has had a lot more prominence because it includes larger losses too. Guys, credit VAR, we can work out VAR for credit risk. We can work out VAR for operational risk as well too. Also, guys, since the crisis, not so much on this slide, mention very briefly liquidity adjusted VAR, that kind of things in the FRM as well, trying to factor in liquidity risk. VAR assumes a holding period, guys, say 10 days, 10-day period, but doesn't mean you can liquidate. We know that in the crisis period, a lot of people could not liquidate at all. Guys, cash flow at risk is the variability here in either your cash flows, perhaps your free cash flows, maybe even your revenues. Look at the variability in your revenues. It's the idea of the volatility coming in here, sometimes called earnings at risk. And when you add one more of something, say you add a brand new position, the incremental VAR, guys, it's the change in VAR from adding an asset. So think of it this way. You've got the VAR before it's added, compare the VAR after it's added. Guys, what the incremental VAR, it's the change in VAR from before to after. That then is the VAR attributed to the new asset. Guys, in that way. Okay, now just as important, we're at the end of this chapter, is the important complementary method to VAR. VAR has some strengths but some key weaknesses. How do you explore the greater severity here? How do you explore, guys, in the tail? So coming back to where we started, those expected losses, unexpected losses. With our stress testing here, we're going to be largely exploring the catastrophic. Because what if, what happens, what if, often called what if analysis in this way. And some of this type of, there's kind of two ways of looking at this. You could think about this as being very low frequency, very low impact, or also stress testing the idea of sensitivity. You know, the idea of when we have perhaps, I don't know, PVO1, 1 basis point of a change, is often known as DVO1 as well, as we know, dollar value 01. When we shock the portfolio with the smallest shock, Guys, we could think about perhaps duration type things here, key rate duration, looking perhaps at short term, intermediate term, or long term. So part of this chapter may actually be quite small little shocks, but part of it could be quite dramatic shocks coming in as well. When you look at a stress test, guys, here, you're starting to stress out the portfolio, causing losses. But I guess some scenarios could be very favorable, or as well as being unfavorable as well. You could have both sets. So guys, this is our first type here. When we talk about a stylized scenario, it's more often the idea of sensitivity analysis here. For example, like your DV01 or your PV01 or your credit spread 01. Guys, a quick link perhaps to our fixed income area here. Remember, in the fixed income area, guys, here, one of the key risks, one of the key primary risks, of course, interest rates. Thinking, guys, about interest rates changing. We're thinking about interest rates rising, of course, guys, here, of course. In other levels, guys, DV01, PV01, you've seen that before. The impact, guys, of a 1 basis point increase. Remember, guys, you've also got in fixed income as well, spread duration. Guys, so spread duration in fixed income as well. So for perhaps a 1% increase in the credit spread, what's the fall in the value of the portfolio? And guys, spread duration and the standard duration you've seen before. And in this area here, maybe you shock the portfolio and produce a VAR. So guys, you've got some kind of a risk engine and you are shocking your portfolio. Guys, you're simulating what might happen. Maybe you're exploring perhaps the yield curve, short-term, intermediate term, or long-term impact, like key rate duration. Maybe you're exploring credit spreads. Guys, you're exploring how different risk factors. So what you're really doing here, guys, is you're exploring your sensitivity to the risk factors that you already know about. Often talk about mapping those factors, mapping them, understanding the drivers of the risk and performance here. So what the guy's saying here, the sequence of change. Sometimes when you change the order, guys, the outcome can be very different. Those types of scenarios happen quite a lot. Trying to understand, guys, our exposures there. Also, guys, bringing in perhaps actual extreme events that have actually happened in the past, whether it might be something like a 9/11, or might be a Lehman's counterparty failure. Guys, it might be a liquidity crisis, or it might be an event from the past. Guys, I guess it might not be those events that repeat, though. Now, when you look at these hypothetical events, like these ones here, there's been lots of examples in the past. A good example, guys, and I mentioned here briefly, is Iceland. Now, Iceland, 3 of their key banks failed, and in commenting on the stress testing, the regulators were criticised for not stress testing extreme enough events. These things that hadn't happened for hundreds of years. Your stress tests weren't extreme enough. So that's the difficulty sometimes, guys, coming up with something that perhaps hasn't happened before or for hundreds of years. In the UK, the Northern Rock, one of our banks, guys, had a famous bank run. That hadn't happened for over 100 years, for such a long, long time. So you might come up with a scenario that seems very, very unlikely, but it has to have some element of possibility. Guys, you might say aliens have landed, they've kind of taken over the White House. There's kind of a fight going on for power. David, you've lost it. You've lost it too much here. It's just too far removed. One of the other methods, guys, factor push. Let's take, for example, some of those investment risk factors. Maybe, guys, let's take the oil price. Now, guys, it wasn't that many years ago when the oil price was sort of $160 a barrel. Seems like a long time ago now. It wasn't that many years ago. And what are we down here? At the time of writing, we're down nearer $50 a barrel. Massive change. If you're firstly, there are winners and there are losers from changes in the factors. If you're an airline and you were previously having to buy in jet fuel and now it's fallen all the way down here to $50 a barrel, guys, we know it's going to be a lot easier for you in your business model. But if you are an oil company, a lot of these projects are no longer profitable at that kind of level. You forecast ahead, perhaps a much higher level of price, and the projects that you're working on maybe even are heavy loss making. A lot of the oil companies showing their figures recently. So factor push, guys, would push the risk factor, like the oil price, against you. You need to explore where the break point is. Guys, explore when you start to really suffer as a firm. This desk here that I have, what is the maximum load in advance? It's kind of wobbling here. What's the maximum load in advance? If you can go there first, guys, you can plan ahead a bit more about how much you can take in terms of stress here, when you'd need to make some changes. Otherwise, you're pretty much unprepared. Now, there are two final methods, guys, coming in here. Maximum loss optimization and worst case scenario analysis. So these two fit in, guys, with the factor push analysis. These are the kind of three key methods here. When we talk about optimizing anything, remember in asset allocation, guys, MVO is a key area. Optimizing is code, guys, for computer modeling. So computers are optimizing this. Whereas in the worst case scenario area, it's a human kind of thinking up these scenarios, more discretionary based. So in the maximum loss optimization, you are using computers to try and kind of find the worst combination here, that worst combination. Whereas in the scenario analysis, someone has to think of this scenario. Now, guys, with the 2007 and 2008, with these downturn periods, with these crisis periods, there were some humans who came up with it who correctly identified, but certainly not the masses. So a big question mark here is, how are we going to do that? How are we going to see into the uncertain future? Very, very tough to do that. Okay, guys, so we're coming to the end of the second segment here. Just to wrap it all up, really, with our stress testing and scenario analysis, really useful as a what if, because we mentioned that as well, complementary to our VAR. We can't rely on VAR. We can't rely on normal markets. We can't rely on things staying the same. There'll always be things that are hidden, because in the risk world, we can't be overconfident in thinking that we've got it nailed. Also, the portfolio is changing over time. Markets are changing over time. Useful to explore how risk is changing too. Guys, okay, so our next segment coming up in a moment, we're going to go on to our credit risk part coming in next, probably the most technical part of the risk area so far, guys. VAR wasn't too bad, but the credit risk bit's coming up next, guys. See you back very shortly. Thank you very much for watching.